This is TreppWire Week in Review for week ending December 23rd, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, stocks were falling Thursday, squashing investor hopes of a Santa rally, and economic data released this week was mixed. Final Q3 GDP surprised to the upside, but housing data was down across the board. Housing starts, pending home sales, and home builder confidence all dropped. But consumer confidence jumped to an 8-month high in December. Manus, the Conference Board's leading economic index dropped more than expected last month, and the upshot is that they're projecting a recession early in 2023.
The word you used early on was mixed, and that's right. There were some green shoots economically on the consumer confidence front, as you pointed out, and on the GDP front. Certainly plenty of crabgrass as well on the housing side of things and elsewhere. But in terms of tone of the market, the tone was decidedly bearish. 3 out of the last 5 sessions saw sizable losses. I think 4 out of 6 actually. One day was flat, and one day we saw a nice rally in there. But the sentiment has gone fully from soft landing, Fed pivot, rate cuts in 2023 to a recession is inevitable, time to keep your powder dry and batten down the hatches. Check in again with us in 6 hours. We'll see if that's still true. The market has been very volatile, not only in its performance, but also in the sentiment of traders and money managers. But this week, heading into the holiday week, the negativity was everywhere. I think that when you see analysts on Bloomberg or CNBC, the operative word is recession and new lows to be hit in equities and so forth. And that's the way it feels. Normally, when you get to year end, in most years, there is a level of optimism. Money managers come into that period having new allocations of cash to put to work. People try to front run what they hope will be a nice beginning to the year rally. There is none of that right now, and certainly the tone is negative.
Yeah, I would agree with you, Manus. The consensus this week is, deciding how deep of a recession we're going to have, not whether or not we're going to have a recession in 23. Goldman Sachs, though, had an analyst that was on Squawk on the Street on Wednesday, and they actually took a little bit of a contrarian view. They said they don't think the Federal Reserve is going to cut rates next year because they think the economy will avoid a recession in 23. So interesting to see, maybe some people, and I read some stuff about 2 weeks ago that actually said on the latest earning reports that a lot of CEOs had used the word recession significantly less on this quarter's reporting than they did in the previous reporting. So I think they said something like it was down 70%, just the word recession. So I don't know if that's a real indicator or not, but someone's actually doing the math on that. My feeling is that we're probably going to see a dramatic slowdown. It's good to see CPI come in a little bit less, but I think the Fed's made it abundantly clear they're going to hold steady. Some of the retail earnings have kind of also highlighted a softening of consumer spending in the marketplace at large. Nike had their earnings reported this week. They beat, but their costs eroded margins, so they were facing higher costs. Micron Technology announced that they were going to lay up 10% of their workforce in the new year. The retail sector hasn't seen a huge bump of consumer spending over the holiday season. So UBS had a report out, said that, a lot of retailers are facing challenging sales season this year because apparel sales are down. Consumers' willingness to spend on soft goods are just significantly reduced compared to like pre-COVID. So the example here was apparel and footwear and accessories in December were down about 16% from 2019 levels. So none of those things bode well for the economy heading into 23.
The thing I like to remind people of is that, these problems that firms face never last forever. And one of the big issues 6 months ago was the supply chain. One of the big issues was higher energy costs, higher labor costs, and higher raw materials costs, commodity costs. And that may be why you're seeing the word recession and concern being used less, because Target was one of those firms that really talked about having inventory issues, right? They're not stupid people, right? They will get that under control. We've seen energy first level off and then come down a bit, right? I don't think there's as much upward pressure now on wages as there was 7 or 8 months ago. So maybe, and I'm just speculating here, this diminishing of the word recession and maybe some hopeful indications is a reflection of the fact that some of the headwinds that we've seen over the last 6 months aren't as daunting as they were maybe in July. What do you think?
Yeah, I think Martha in lead-in talked about consumer confidence, jumping to an 8-month high. And interestingly enough, I think there was optimism around, less concern about inflation, more optimism about jobs and the overall economy. So kind of to your point, Manus, of maybe the worst is behind us. Part of that is the lower gas prices that I think consumers have been seeing. So Gas Buddy did a survey. They basically are forecasting national average gas prices are going to be around $3 a gallon, heading into the Christmas holiday, which is an 18-month low for travelers. So to your point, everyday cost for folks have maybe started to come down. I think we're seeing that with groceries, gas, et cetera. And so maybe there's a little optimism around there. If we look at the housing market, though, there's still some headwinds there. So there were a few reports this week around National Association of Home Builders released their sentiment analysis and basically had the lowest set of confidence since the pandemic. In fact, it went back to like 2012. This was the lowest reading since 2012. Permits were down fairly significantly. Permits fell about 11% on new construction. More headwinds there. Bill Pulte, who is the CEO of Pulte Homes, was on a couple of news sites this week, basically saying that in addition to the inventory challenges that everyone's facing right now in a rising interest rate environment, that zoning is the top concern for them. So they're getting a lot of pushback from the municipalities and, others in locations where they're wanting to build, where just additional administrative costs and overhead are making it difficult for them to even sell starter homes, et cetera. So I think there's still some headwinds. It'll be interesting to see how those things play out over the coming months. It's an interesting way to end the year, I'll say that.
So let's stick with that issue, the Pulte issue that you were talking about a minute ago in the zoning. What is the motivation there of the government to kind of raise this? Is it to raise revenue, or do they feel like there's too much inventory and they're looking at a glut? Or is it taxing the local services too much? Give me a sense, if you can, about, what his concern was in that realm, if you had any insights there.
Yeah, I think it's a combination of all those things. You have a lot of local municipalities that feel like services are being stretched thin. You have a lot of municipalities that don't want the influx of new people coming to the city, creating congestion and traffic and other things, overcrowded schools, et cetera. You also have, and this doesn't apply directly in this case, since Pulte's more of a single family home developer, but more on the multifamily side, getting a lot of pushback where it's really neighborhood associations and other folks in the community that don't want larger, more dense developments in their locations. And, the challenge there is that at the end of the day, it's a supply and demand economic issue. So like if developers have the underlying demographic and fundamental data there to say, hey, this is where we should build, even in spite of the headwinds, in spite of the costs, in spite of the delays, they're still going to build there because the market will support the price. But what it does is inadvertently price out certain segments of the market. So as an example, in Austin, Texas, the city council there's decided to be kind of a no growth city. But when Tesla relocates there, when Charles Schwab relocates their headquarters there, the influx of people are going to be there. So you have dwindling supply because of some, local municipality decisions. The cost to build is significantly higher. So in order for developers to be able to make it pencil, the price of the house or the price of the rent has to go up. And as long as people are willing to pay it, they're willing to build it. But you look back in 10 years and you basically have no entry-level housing, or you have no affordable rental units in a market. So I think it's fairly systemic. There's a lot of cities across the U.S. that are facing those challenges. And hopefully at some point, we realize that if we want to, bring affordability and accessible housing to the marketplace, really the only cure for that, in my opinion, is having more supply. And having more supply goes back to having, builder-friendly cities and municipalities that allow developers to come in and actually create a product that the market's demanding.
That was a great explanation. Thank you. Let me take a detour here for a minute, because we're talking about the deepness or shallowness of what might be a recession next year. I saw this banding about on LinkedIn maybe this week, or maybe it was Twitter. I'm not really sure. I'm not on either very much, but I did notice this one thread. It came from a young guy who I got the sense was in the market, in the commercial real estate market for the last 3 or 4 years. And he was asking, how does this feel compared to what you guys were looking at in early 2007, when you were starting to see delinquencies tick up, when you saw values surging and so forth?
I feel like it's all in the future, right? I'm not saying that there's not data points that are reflective of a softening of market. Clearly, that's true in the housing market and some other subsectors, but all of this is on the come. It's not yet here yet, right? So it's what's going to happen to earnings for retailers. This is all projections based on what we know about inventory and consumer behavior and all of that. What's going to happen in office? Again, another prediction based on whether people come back to the office. So I feel like it's not yet as bad as it was in 2008, because that was actually happening real time. I mean, we saw the implosion and the cascade effect across the financial market. I don't feel that we're seeing that yet, but we're seeing a lot of predictions saying that it's going to happen.
I would agree. I think we saw a lot of companies fail during that time in 08. We saw a lot of known commodities fail. And then, the sentiment trickle down from that, I think, just reverberated everywhere, and liquidity dried up immediately. You couldn't get financing. Like, the market pretty much just stopped. And I think in this case, some of those same ingredients are there on the horizon. You have really high interest rates on a relative basis, what we've seen over the last 5 or 10 years. You have consumer confidence up, we just said this month it's up, but generally consumer confidence has been fairly negative. You have the whole work from home and office stuff that's kind of hanging out there. But surprisingly, the delinquency numbers are actually down year over year. Surprisingly, rents continue to go up and people continue to pay. Unemployment hasn't become a huge issue. And while a lot of the national banks pulled out of the lending market for the last few months, I've actually started to see stuff over the last couple of weeks that maybe in January they're going to get back in the game and start lending. So, the availability of capital, I think, is the biggest difference. People are still able to do deals, even though the cost of that capital is higher today than it has been. But there hasn't been an erosion of the availability of capital on a macro. And so I think as long as people can get financing, as long as there's a secondary market for capital, I think you're going to see a softer decline in values and other things. Sure, properties aren't viable. There's going to be some keys tossed back to the lender, but I just don't see it being at the pace and scale as it was in 2008. Now, maybe this drags on and then we're still talking about this in 3 years. I think that's a real possibility, but I don't think we're going to see the overnight systemic kind of brunt effects of market collapse like we saw in 2008.
We're certainly in a better place today. The banks are more well capitalized, so the likelihood of higher delinquencies, losses, lower valuations, the likelihood of that leading to bank failures is much lower. We shouldn't see that. I would argue that lending hygiene for the last 10 years has been better. We haven't let borrowers lard up with B Note 1, B Note 2, B Note 3, et cetera, to the point where they have negligible skin in the game. And I don't think, even though you could argue that values in multifamily are unsustainable, but in 2008, values were unsustainable across the entire property segment. Every single part of the commercial real estate segment were overvalued then. So we're in a better place. I think the two linchpins, linchpin one, which is just US only, is, how much do these rate hikes influence unemployment? And if we keep unemployment under 5%, I would double down on my prediction that the trough is fairly shallow. And then the other two parts are geopolitical, right? Which is, do the things in Eastern Europe get worse? And does the energy supply chain break or weaken to a point where there's externalities in there that we just can't control at all? So, but I'm still hopeful. And I think that we are in a much better place than 08.
We just released data that was published by our sister company, CRE Direct, and it looked at the universe of commercial mortgages. It broke it down by lender type, maturities, property sector.
Yeah, so I'm going to give a quick plug to the folks at our CRE Direct sister company. If you're not subscribing to the CRE Direct news feeds, if you're not a member of the website where you're getting this data available, you should be. There are various levels of subscription. There is a free version where you'll get access to this type of content for no cost. But the takeaways here are pretty remarkable. So universal commercial mortgages actually increased by a fairly large amount in the third quarter, about $475 billion. Was almost a 10% increase year over year to about 5.52 trillion. One of the interesting takeaways from this was that the volume of multifamily loans that were outstanding increased to more than $2 trillion, which was the first time that that's happened. That volume was up about 171 billion, or about 10% from the previous year. And it wasn't really driven by just the GSEs, because we've talked about how the GSEs actually didn't even hit their caps this year. So there were other people that stepped in and took on some of that multifamily financing opportunity. So if you want the full article or you want to see the full chart, as Martha mentioned, there's a really nice infographic in the article that actually breaks it down by year, by lender type, et cetera. Another interesting takeaway was just the stuff we've talked about in terms of the maturities. So we're looking at about 447 billion worth of maturities in 22 over the next couple of years, ramping up to where in 2025, we're looking at about 500 billion worth of maturities. So, over $1 trillion over the next, 2+ years, if you look at it from a maturity perspective. So to Manas's previous question, if the distress actually starts to hit, there's going to be a lot of properties that have upcoming loans coming due that we're going to see play out in real time over the next couple of years.
Turning to office, we've talked about some of the bearish comments, and one of the most bearish I've seen in the last couple of days was Don Peebles of Peebles Corp. He was on CNBC basically saying that office space REITs concentrated in some of the major markets are going to see some significant losses in the coming years.
I think that we are bracing for that. I think that going back to Lonnie's point a moment ago about our sister company, Commercial Real Estate Direct, they put out an annual magazine that's going to come out in early January, which we distribute at the annual trade conference in Miami every year. But then we use those articles. So anybody who's on our blog list will see a lot of this content. But one of the pieces we were putting together was, here are somewhere between 10 and 20 properties that we're watching around the US, office properties, that will get our attention in 2023. And when you look at the distribution, there's really one or two of these in every city, right? New York's got a couple, San Francisco, Chicago, Pittsburgh, Minneapolis. They all have situations where the loan is maturing and the debt service coverage is marginal at best, maybe a 110, 115, or in some cases under 1, and or they have a significant tenant base which is uncommitted beyond 2023. And that'll be an interesting piece that we'll distribute and we'll talk about next month. But it's going to hit these big property owners, the owners that have short duration tenants and financing needs will be the most under concern. If you layer on top of that age of property, condition of property, and whether it's considered, class A, B, or C, will have an impact or two. But for those that think that this might just be a San Francisco and New York phenomenon, it really isn't. It's just about every major city has a couple of stories.
But we do have some good news. It's not all doom and gloom. So let's bring everybody up a little bit with some green shoots.
We do have plenty of green shoots. We got some not so green shoots too, but even the crabgrass is, I would say, it's not bamboo. It's modestly crabby, right? There's patches of real grass in the crab, but we'll start with the good stories. A lot of them I really enjoy reporting on here. This comes from the Philadelphia Business Journal. Paul Schwedelson, Chubb, is going to be developing a new $430 million office in the city center in Philadelphia. It will house at least 1,200 new employees, in addition to about 2,000 employees they already have in the area. So a net growth of about 50% of the number of people working. The property will be at 2000 Arch Street, which is Arch and North 20th Street. Right now there's a parking lot there, but just a real big vote of confidence that a big pharmaceutical company is going to put up a huge, nearly $500 million project when we have so much uncertainty about office these days and returning to office. I love that story. In Dallas, Granite Properties and Highwoods have gotten together to purchase McKinney and Olive. This purchase was for almost $400 million. The story comes from the Dallas Business Journal. So again, here are two office operators spending a lot of money in a time of great uncertainty in the office space. Down in Miami, Kirkland and Ellis has signed on for 115,000 square feet at 830 Brickell Plaza. That building is expected to be completed early next year. That story comes from Reuters. This seems to be ground zero for law firms in Miami. That particular project already has Winston and Strawn, Sidney Austin, and Baker McKenzie in it as well. So good on them, those developers, for filling up that building. In Cleveland, Stan Bullard reported that Sherwin-Williams is going to sell a 90% stake in its new headquarters, which is under development. The stake will be sold for $210 million. This is effectively a sale leaseback type thing where the property value is about $235 million, if I did the math correctly. And lastly, in the green segment, and I'll be interested to get Lonnie's take on this, Lingerfelt, developer Lingerfelt, or I should say investment money manager Lingerfelt, has sold off an 11 property office portfolio in Innsbruck, Virginia. The buyer was Seminole Trail. The sale price was almost $119 million. The portfolio contains a little over 700,000 square feet and is 82% occupied. The interesting thing here, and this is the part that I wanted to discuss a little bit, they reported a cap rate of 6.3% on this sale. And cap rate is not something you see reported all that often. And of course, in the reporting, you don't know what the cap rate is based on. You don't know any of the details of it. But I found it interesting that more and more over the last month or so, in reporting, I'm seeing cap rates being mentioned where I've never saw them before. Do you make anything of that, Lonnie or Martha? Do you have any thoughts about why we might be seeing cap rates reported now when in the past everybody was so close to the vest?
Yeah, I think the major reason for that is people are trying to anchor what the real effect of the market is. And if you look at just things on a price per square foot or a total sales price perspective, you don't get a true feel for that in some instances. And so, people realize at this point, cap rate is something that is kind of the great unknown because there's been a lack of transactions on a relative basis compared to the last few years. So I'm sure as people are, positioning themselves either as the acquisition firm buying this, they're trying to use cap rate as a way to say, look, we got this at a discount compared to what we would have paid 2 years ago. Or if you're on the sell side, you're trying to say, look, the sky's not completely falling. We're only 75 basis points higher than we would have been if we had exited before. I think what's interesting on this one is the fact that it was a portfolio sale of offices. I would not be surprised if we start seeing that more. So when Martha talked about the Don Peebles interview and some of the REITs in major cities being impacted, you reported on a story a couple of weeks ago, Manus, where I think Starwood had sold off a large, subset of properties out of a hotel portfolio. I think we could start seeing some of that on the office sector where some of these underperforming assets that are 70 or 80% occupied might get bundled up and sold off to an opportunistic investment firm. And then the REIT or whomever owns the broader portfolio, keeps the Class A property. So, I think we'll start seeing more cap rate because people are asking the question to try to see where we're at in the market, use that as a proxy. And I wouldn't be surprised if we start seeing some additional, office portfolio transactions as well.
Yeah, we did see it here. We saw it in many retail properties in the last couple of weeks, cap rates being revealed. I almost wondered if this was kind of like a dog whistle from the broker community. They didn't want to have uncomfortable conversations with their other clients. So if they said, if I slip this into a press release, it's going to kind of soften up the market for that phone call where I have to tell them, you're not trading this at a 475 cap anymore. This is going to be a 6 handle. Maybe that's the case, maybe not. I don't know. But it was my speculation, my own interior monologue that was going on, which never ends, I might add, that said to me, this is a way for brokers to kind of deliver bad news without hearing it coming through the phone speaker.
Yeah, I think that's actually probably a legitimate reason. We talked with some folks over the last couple of weeks where, they're saying the bid ask delta, from sellers and buyers is still around 30%. So, if you're a broker, you get paid when the transaction closes, right? So you're trying to get that deal across the finish line. And if you're at a 30% delta at the onset, it's difficult to get that across the finish line. So that would actually be a pretty good strategy to get some of those whisper cap rates out in the market. And maybe your seller acknowledges that they're going to have to make some adjustments.
Okay, let's move on to some of the more mixed green and crabgrass.
Yeah, none of these crabgrasses are particularly terrible. In Pittsburgh, the Gateway Center loan, $98.2 million CMBS loan, the property is backed by 1.4 million square feet at Liberty Avenue and Stanwyck Street there. That loan missed its maturity date this month. It wasn't really a big surprise. The DSCR has been under 1.0x and has been for a couple of years. Occupancy has been below 70%. So the fact that this thing has gone into office CMBS purgatory, not all that surprising. But why do we call it mixed and not hard crabgrass? Well, in our TreppWire reporting over the last 6 months, we've noted that the owners of this property have signed 5 or 6 somewhat small to decent size leases. So some in the 20,000 square foot range, some in the 40 to 50 to 70 square foot range. But little by little, I think this property is fighting its way back. So 2 takeaways from this. One is directionally, this thing is moving in the right compass direction. But also, we pointed out before that every city has one of these, and this is one in Pittsburgh, right? Pittsburgh, you don't think of as an area of big distress, right? It's not San Francisco or New York, but here is the one loan that we'll be watching very carefully in 2023. I think this one muddles through just because of the momentum alone. We had a trading alert earlier this week, I think, or maybe it was late last week. The $235 million 285 Madison Avenue loan has been extended. The loan was transferred to special servicing last spring. The borrower requested an extension. The loan matured last month, and the modification pushes the maturity out to 2024. So, I think this becomes the model for maturing loans in many ways. Here, DSCR was slightly under 1, but occupancy was 96%. There's some B-note debt on the property, so the effective DSCR is even less than the 0.97x that you see for the senior loan. But I do think that unlike some mall cases where people decided to give back the keys, it didn't happen a lot, but it did happen. I think that a lot of these office owners will try to squeeze out that 1, 2, 3 year extension and live to fight another day. So this is a property near Grand Central Terminal in Manhattan. Also in Manhattan, another Madison Avenue property, 515 Madison, was sent to special servicing. Again, a Midtown Manhattan office there. The loan represents 30%, a $103 million CMBS loan represents almost 30% of a 2013 deal. DSCR was under 1.0x in 2021. And for the first 9 months of 2022, this loan, again, might be one of those places where it sits in purgatory for a couple months and then ultimately gets modified. One more outside of New York, in Denver, the Republic Plaza loan, $243 million loan, missed its balloon date. The collateral is 1.3 million square feet in downtown. The property has lost a couple tenants over the last couple years, and we'll be watching that one in 2023. For the first 9 months of 2022, DSCR was 1.29x. The borrower has submitted a workout proposal.
Yeah, so a common theme between all of those deals, Manus, is, lower occupancy. The Pittsburgh office was 69% down to 67%. The Madison Avenue deal, 515, 75% projected occupancy based on a pending termination. Looks like they're currently at 84%. And then the Denver office, down there in that low 80% range. So I think we've been talking about that. We're not seeing any of these offices sitting at 90+% occupancy. So if you're on the debt side of this, 80% might be best case. We're not real sure what the worst case is at this point.
Yeah, the interesting thing right now is that you wonder how much of this will result in borrowers that might have been able to refinance these things just using this purgatory and the ultimate extension of the loan to just lock in lower costs, right? When we saw 2008, liquidity had dried up. Certainly there was no lending going on to speak of at all, but rates had collapsed, right? The Fed just completely collapsed rates. So in theory, if you were eligible for relief, you probably could have worked out a lower debt service rate. Here, the game may be hold on to this thing, let it play out for a while, maybe get your loan to be interest only instead of amortizing, and tack on another 3 years and keep that 3.5% coupon for as long as you can.
Yeah, it was really interesting a couple of weeks ago on one of the panels I was sitting on. Some of the lenders were saying, they're putting in, and this was outside the securitized space, but pretty stringent prepayment penalties and exposure for folks that they were financing today, because obviously the hope for the borrower and the market is that rates are considerably less in the next couple of years. And so that's been something for them where they haven't been able to lock in higher coupons because rates have been so low. Now, from the lender side, if you have a good deal and you're able to finance it and you're getting favorable terms to the debt, you don't want 24 months to go by and then refinance out and you not be made whole on that. So I think kind of a little bit of a paradigm shift there in terms of just where the market is. So I agree with you. I think we'll see a lot of modifications or people trying to work out deals in the hopes of, capturing a lower environment in a couple of years.
For newbies out there, someday, Lonnie, next year, we'll have to have you do an educational segment on prepayment restrictions and what kinds are out there. For people who are new to this market, in the residential space, you could prepay anytime you want. That freedom doesn't exist for all commercial real estate debt, and certainly not for fixed rate commercial real estate debt. It's more free in floating rate debt, but maybe next year, Lonnie, will tee that up and put on your tweed jacket and give us the Professor Lonnie rundown.
Yeah, I have to dust that thing off. It's been a while since I've had it on.
Do you have the patches or no patches?
Oh yeah, patches for sure, patches, and a little whatever smoking pipe, So yeah, for sure.
One more I'll throw out there in the sublease category from the San Francisco Business Times. Chime, which is a fintech company in San Francisco, they put out 2 floors of space at 101 California Street in the financial district, and Cloudera in Palo Alto. This story from The Real Deal has put 40,000 square feet of space at 525 Market out in the market for sublease. But in the Real Deal piece, they made a remark that they were citing the New York Times. They called the San Francisco Business District the most empty downtown in America. Not a good look. And I got to say, it's been a tough week for San Francisco. They seem to be on the precipice of getting Aaron Judge, and the Yankees kind of pull him back from the brink. And they had that guy, the shortstop from Minnesota, that they seemed ready to announce his signing, and he backed away too. And now the New York Times is piling on. Not a good week for the Bay Area.
Let's move on to retail. And usually around this time of year, you start to see stores announce right sizing some of their store footprint. So we had a number of stories that came out about retailers talking about what they were going to do regarding some of their stores.
Yeah, I had one in San Francisco. I'll take the other side of the coin here just very briefly. This one came in today. On Geary Street, Banana Republic has just signed a lease at, I think it's 152 Geary. It's a Sitt property, Joseph Sitt. The loan on that property had been delinquent, and I think the property had been vacant for a while, and now they just added Banana Republic there, which is a nice story for 2 reasons. One is you don't see a lot of retail growth, new leases being signed in San Francisco right now, so we like it for that reason. And it may end up helping cure a CMBS loan that has been troubled for many months. So we'll have to keep watching that story in 2023.
Yeah, so to your right sizing comment, Martha, a little play on word here. Rite Aid has announced that they're going to close 145 unprofitable stores. They've already started that process, and they may actually identify some additional underperforming stores. This was according to some executive disclosures on Wednesday. Looks like they're sitting on about a $67 million loss for the quarter, and they're projecting even greater losses for 23 fiscal. Big Lots, medium-sized junior anchor tenant across the U.S., basically said that they're going to, close more stores. They released locations of some of their store closures and, brace the public that 2023 was maybe going to see some additional closures. On the good side, though, Barnes & Noble announced that they're going to add 30 stores in 2023. So after about 10 years of shutting down stores, I think this was from an article in the Wall Street Journal, basically from 2008 to now, they've gone from, just over 700 stores to about 600. But they're hoping to add 30 stores in 23. Kind of a new concept. They're going to be smaller in size and opening in markets where their larger locations were unprofitable. So rooting for Barnes & Noble to be able to make a comeback there. And then discount clothing store Burlington is on track. They're going to open up about 90 stores this year. So it says they expect to have 87 net new stores over the next year. And then Ross Dress for Less expects to add, almost 100 stores across the U.S. this year. So a little bit of crabgrass on the Rite Aid side, but some really, hopefully good news for some of the larger, more notable credit tenants across the U.S. with Barnes & Noble, Burlington, and Ross having an expansion in the works for this upcoming year.
We'll have to throw out a shameless plug for Martha. She's coming out with a tell-all next year, Thursdays with Lonnie and Manis, which goes behind the scenes of the podcast. So look for that. I think you're doing a national tour, right, with some book signings, and it's got to be riveting.
We definitely have a cult following. There's no doubt.
Well, I was going to say, I don't want to steal your thunder on the CREFC news. I'll let you give the highlight on that, Martha. But for those interested, Martha will be at CREFC in Miami, and I will set up an autograph booth. And we accept cash, check, Venmo, whatever, for a signed autograph from Martha Kocher.
Don't sleep on this one. Remember, there was that bestseller years ago. What was it? Tuesdays with Maury, right? This is Thursdays with Lonnie, right? This is, it's not quite a sequel, but it might be just as riveting.
Speaking of riveting, we got a couple more stories.
Yeah, I'll throw these out very quickly. We're getting late. I know everyone wants to do their last minute holiday shopping. These are all kind of pretty good stories in the retail space, in the mall space. All of these were in our TreppWire litany this week. In Virginia, the Chesterfield Town Center, the value of the collateral behind that mall was reduced. The loan is a $92 million CMBS loan. It backs a 2012 deal, also part of CMBX 6. Why is this a relative green shoot? The collateral was valued at $170 million in 2012. This month, the value was lowered to $101 million, but that $101 million still leaves positive equity. There's still skin in the game, if you will, for the owner there. So this might be one of those loans that muddles through, and we certainly hope so for CMBS investors' sake. This loan was to mature in October. Going back to commercial real estate direct, again, there was an extension finalized on the South Park Mall. This is a 400,000 square foot piece of collateral in Richmond, Virginia. At securitization, this collateral was valued at $103 million, was later lowered to $40 million, the value in 2021, which is significantly below the outstanding balance of the loan, which is $54 million currently. So why is this a positive story? Well, the loan was extended to 2026, and what that means is that the owner, CBL, is looking to keep this thing and is willing to fight for it. You might recall CBL filed for bankruptcy last year. And lastly, a $281 million loan backed by malls in Hoover, Alabama, Columbia, South Carolina, and Rochester, Minnesota. An extension has been negotiated there as well, and that loan looks to live on.
On to our programming note, which Lonnie already gave a little bit of a sneak peek on. We're going to be at CREFC Miami January 8th through the 11th. You can meet us in our hospitality suite. The whole pod team will be there. We're going to be in suite number 412, and we'll be happy to talk about anything you're interested in, whether it has to do with CRE or some obscure musician, band, something like that we've brought up on the podcast. So
College
stop by.
football, lower back pain, running shoes, anything you want. We could talk about anything. Pickleball,
There you
all of
go.
that's on the table. We're really, we could talk business, or we could talk pleasure, or we could talk non-pleasure. Any of
Exactly.
those are on. Are we going to have, Martha, are we going to have podcast t-shirts there to give away?
We have some special t-shirts. I cannot give away too much because I'll steal Haley's thunder, but we're going to have some pretty cool t-shirts to hand out if you stop by.
Nice.
And on shoutouts, Savino B, a friend of our own Jen Spillane, sent over a shout out. Big podcast fan, was apparently talking about us with some other students while out at dinner, and apparently folks said they also listened to the podcast. So kind of a crazy moment of fate there. Duke of Dirt on Twitter recommended our podcast. Every real estate investor should be listening to. Michael MBA on Twitter. Michael MBA is someone we've known for many, many years. So nice to see a shout out from him. And our own Susie S got us all custom pickleball shirts because, well, we mentioned it so many times that I think she felt compelled to hook us up with that. And at the risk of bragging a little bit, Business Insider ranked the TreppWire podcast as the best for CRE news. So I don't know, guys, we must be doing something right.
Yeah, I guess so. I mean, that's quite an honor, and I really give you guys and Haley all the credit. I'm always blown away by the topics you bring to the table and your insights and so forth. It's just a great thing. I'll throw in one more shout out. I got Stephen L. in Tuckahoe, New York, who said he's a new listener. He's checked out a couple this week. We'll give that little Easter egg out there to see if he keeps up this week and checks out the pre-Christmas version.
And we released our 12 Days of Christmas blog, which is a little bit of fun and a bit of news and data. So if you haven't had a chance to check that out, you should check it out on our blog. So I was going to give you guys a chance to give away what wish you had. Lonnie, what's your wish?
Well, I think from a CRE perspective, I'm hoping the markets get some sense of stability and that we head into 23 and we're talking, in December of 23 about what a great year the CRE markets had. So we've had a lot of talk about uncertainty. Like you said earlier, Martha, there's a lot of potential distress on the horizon. I'm hoping it plays itself out quickly and we're back to talking about the good times here at the end of 23.
I'll follow up with something kind of akin to what Lonnie is saying. It comes as a cliche this time of year. We hear it sung in songs and endlessly, but we tend to just kind of brush past it, or maybe we even laugh about it. Sometimes it's a line in a movie. But peace on earth and goodwill, it just seems like we live in a society or a world where people are always fighting with one another. Goodwill is in short supply these days. It seems like if you follow Twitter or the newspapers or people on TV, they're always yelling at each other. So it's not really an idle wish. It's a hope that 2023 brings peace and goodwill to all our listeners, all their families, and everybody worldwide.
Mine's not quite so noble. I will say that it's nice to see tourists back in the city. The streets are teeming with people visiting Rockefeller and the whole area around there, and street musicians are back out. So honestly, it's a little thing, but it's nice to see New York come back a little bit from where it was. So with that, we'll close. Thank you to our producer, Haley Keene. Join us next week as we look at what's happened during the week. And next week, we will be having our pod, giving our predictions and a look back and talking about how that impacted you. So you should have a listen. If you have a question or comment, send your email to podcast@trepp.com and subscribe with your favorite provider. Thank you for listening and stay well.
All right. Ho, ho, ho.
Merry Christmas, baby. Reindeer's coming out to play. Santa Claus is packing the presents, making sure you've been behaving okay. Merry Christmas, honey.